Welcome, friends. Today, in this session, on the topic of security valuation, ICAI Ashish Gupta, Deputy Director Board of Studies, welcomes you all. Student, in this session, we shall discuss the topic of bond valuation basically because earlier in two classes, we have covered the security valuation that is related to equity. Now here we shall cover the topic of bond. Student, in this regard, please note that although we call it as a bond valuation, but as per my opinion, I say it is kind of a fixed income security valuation because bond is only a type of fixed income securities, whereas there can be a n number of securities. However, generally there are two type of securities that are normally covered in the under the this fixed income security. Three, we can say three. One is your bond, another is your preference shares, and another is your money market instrument. So far as the fixed income securities evaluation are concerned, sometimes it is said that when we are valuing any fixed income securities, why we need so much of analysis? Because in case of equity valuation, we have seen that they are affected by many factors like market, macroeconomic factors, and a lot of things are there. Whereas in case of a fixed income securities, there's nothing like that. If you recall that, students, when we used to talk about your partnership firm, there were used to be option or sole proprietorship their firm. There used to be a partnership arrangement and there is a used to be loan arrangement. Okay, in case you borrow the money, the lender will get a fixed interest, fixed income after a certain period of time in the form of interest. Whereas if you get joined or another person joins you as a partner, then profit and losses are shared. Of course, he or she is bearing the risk. So we can say that normally it is said that whenever we invest in any fixed income securities, there are no risk. No, it is not nothing like that. In the forthcoming classes sessions, we shall see not only the securities, equity securities, as well as fixed income securities are also affected by the risk factors. What are these risk factors? We shall discuss the same and how we immunize ourselves to these factors. We shall see in the discussion. Okay, student. So now let us start our discussion. There are many good mornings. Good morning, students. One second, students. I am just connecting you to my PPTs. Now, students, when we talk about as I told you, we are discussing on bond valuation. Now, when we talk about, as I told you, we should call it as a fixed income securities. Now, when we talk about fixed income securities, first of all, we have to see what are the various categories of the fixed income securities. Okay, it can be bonds, or it can be debentures, or it can be preference shares, or it can be money market instruments. Okay, Drew. Now, student, please note that regarding these three factors, these three securities, the duration is normally ranging from 3 years to 5 years or even more. Whereas in case of money market instruments, the duration is less than a year. So that's why it is not called as exactly the bond. Rather, they are called as a fixed income securities, and that's why they are called money market instruments, because their trading period, their duration may be range from 1 day to 365 days maximum. So now under this category, when we talk about the bonds, these can be government bonds. Okay, these can be your corporate bonds. Okay, when we call up, say we talk about our money market instruments. अच्छा अच्छा हाँ, ठीक है, 1 second. ओके, ठीक, ठीक है, ठीक. Okay, student. Now this can be call money, call notice money. Okay, this can be treasury bill. This can be commercial bill. This can be corporate deposits. This can be commercial paper, or this can be repo, reverse repo. Okay, student. So we shall discuss all these money market instrument in our class also. So don't worry about the same. And just today in today's class, I will my concentration will be on the bond aspect. Now, when we talk about the bonds, especially in context of corporate bonds, before I go to the corporate bonds, now these government bonds are also called gilt as securities, or gilts only. Why they are gilts as securities? These are called because there was a time when these bonds were issued by the government. Their outlines were used to be with a golden color. So that's why they used to be called gilt as security till date. Because generally it is considered that government securities are normally risk free. Now we are coming to, this is called money, this is notice. Now we are coming to the bond category. Now I am coming to the corporate bond. While we talk about the corporate bond, 1 second. One second, students. One second, students. I think there is some issue in this. Now, when we talk about corporate bonds, the various types of corporate bonds can be. So, would you please once tell what is the corporate deposit? See, better corporate deposit basically it's a like in case of a fixed deposits in a bank, it is same way it is also deposited with the private companies or limited companies. Now the trend is not that much, but there was a time around in 1996. There was a trend where the companies have started floating, inviting the deposits from the investors that they can invest the money for the short term. So it is called corporate bonds. I will throw the light when we the topic will discuss. Now, first of all, it is called state bond. Okay, then it is zero coupon bond. Then it comes floating rate bond. Then it comes junk bonds. Then it comes index bonds. Then it comes bonds with the embedded options. Okay. Under this category, there can be three type of bonds. One is convertible bonds. Okay. Another is callable bonds. Okay. Then another is putable bonds. Okay, students. So these are the various kinds of a bond that we will discuss now. First of all, when we talk about state bond, or it is also called plain vanilla bonds. Student, when we talk about plain vanilla term in a context of finance world, normally it implies a very simple thing, very plain, very simple. Okay, because in financial instruments, normally what happens, we used to add some say these terms and conditions in such a manner that it becomes complicated. Okay, so plain means a very basic. Plain means a plain vanilla means a very basic. Now, when we talk about this bond, vanilla or sweet bond, it has some characteristics. Okay, what are these characteristics? First of all, it has a coupon, and this is periodic. Okay, coupon or interest payment is periodic after a, because what happens, suppose if I simply says, if you recall that when you in the 12th class there was a term like when you used to issue the debentures, so there were used to be prefix 6% debentures. So 6% debentures means the interest at the per annum will be paid at the 6%. Okay. So now when we talk about the coupon can be annually, semi-annually, or quarterly. But most of the questions, the interest payments are mainly on the basis of annual basis. Now there is a very interesting fact regarding why these are issued called as coupon. This is called coupon payments. There was a time in earlier time in USA, what used to happen whenever any debenture are issued, so the debenture used to be in that form. Okay. Now suppose the debenture, see student, before I proceed further, it may be possible that I may use the term debenture and bonds interchangeably because financially both terms have a same meaning. From financial valuation point of view, both have a same aspect. Only the difference is that while the debentures are secured one, bonds are not that much secured. Only this is the difference. Otherwise, from financial point of view, both are the same thing. So it may be possible that I may use the both terms interchangeably. So see student, if a company has issued 1,000 bonds, say at say 4%. The coupon are the say the 4%, you can say 4% bonds of 100 each. Now this 1,000 means par value. Okay, that I will discuss with you. Now on this par value, the coupon, the interest payment will be of 4%. Okay, accordingly, at the end of each year, the 4% on 1,000 will be paid. Okay, student, at the end of fifth year, the principal will be repaid back. Okay. Now, what used to happen? These were used to be in a form of perforated coupons form. Okay. So whenever, say, at the end of first year, this coupon is removed and sent to the company, and company will give the money to the holder of the coupon. They will credit it in their bank account. Similarly, at the end of second year, this coupon is removed and sent to the company. So that's why it is called coupon. Now, very interesting fact, student, these coupon are used to be separately traded. These coupon are used to be separately traded. So that's why they used to be called as strips. These are called as strips. Okay, student. Now Similarly, this also can be sold because after say 5 year period of 5 years, this money will be returned. So this is also become the part of strip. So these are even a part of, you can see a part of bond can be sold individually. That is called strip. Okay, student. So I hope you have got understood what why we call this as a coupon. Okay. Now next, par value. Okay, or face value. Like in our earlier example, dollar 1000 is our par or face value on which our coupon is based. Now, when we talk about par value, it is relevant at the time of issue and it is relevant at the time of redemption. It can be issued at par, discount, or premium. It depends on the value on which the debenture or bonds are issued. Please recall in your topic on the cost of capital, there you are provided with the if a debenture issued at a price this much. Okay, if bond is issued at a price this, it is bond is available. So it can be same or it can be available. Not it, because it can be a second hand option also. However, when we talk about redemption, normally it can be at par or it can be at a premium. Normally, there is no such provision that the debenture will be redeemed at or bond will be redeemed at discount. It happens only in case where a company defaults. Then it can be possible that there may be some haircut because whatever with the lesser amount is paid, it is called some kind of a haircut. So it is only that case it is possible. Okay, student. So this is basically, and that's why it is called phasor. So these are quite some features of the simple bond. Now I am coming to another category, zero coupon bond. Okay, student, this is very interesting category of the bond. Now, as the name indicates, zero coupon means no interest, but it is not true. It pays interest. Okay. However, this interest is paid cumulatively. Okay, student. Now, as in my earlier example, where I have issued a bond at $1,000. In this case, what happens? Say same bond of 1,000. Okay. Now what happens? What will happen? I am not paying any coupon. Okay. Suppose if I ask an investor to invest the money zero time, and I say after say period of 5 years, you will get same amount. Now today, if I say a person that you invest 1,000 after 5 years, I will pay you 5,000. Whether the investor will be ready? No. Why? Because here the concept of time value of money comes into the picture. Why the investor will say, okay, I today invest 1,000 after 5 years, you just give me one. Because I am losing something. I need compensation. In my simple plain vanilla bonds, I am getting interest for this intermediate period of 5 years, here I'm getting the interest of this. Okay, but here I'm not getting the interest. So why should I will buy this bond? Accordingly, what I say, these are issued at discounted prices. These are issued at discounted prices because here the interest will be paid cumulatively. So accordingly, we can say that for if the zero coupon bond is issued at 4.5%, then what will be the value? Okay, let us see how the value will be computed. So we can say the value simply is computed by using the concept of time value of money. Okay, student. 1 second, I check me the query. Uh, what has been written after junk bond? Let me check better. After junk bond, it is indexed bond. Index. It is index. EIND. I just rewrite it if you are facing a problem. Okay, student. I am taking the next query. Okay. As investment accounts are prefix, sir, could you 1 second? Maisha is saying, sir, fixed income securities. We are talking about government securities. No, Maisha, it can be anything. Fixed income securities can be of a corporate as well. It is not like said. It is not that it is only the this securities only. It can be anything. Okay, it can be any. It can be issued by the corporate. This is tell me about after has been junk bond. The investment account we used to use. Yes, in investment accounts, Suraj, you are right. Normally in investment accounts, we also use a prefix because here the interest or the whatever we shall receive the same. Okay, then at the end of in the end period, Masha, it's a 1040. Yes, of course, it is both, but coupons are normally used to be separated. So last, what used to be happen? The last portion of principal as well as the interest, it is used to be sent combinedly. It is not used to be perforated. But however, if you want to sell it separately, it can. It is also possible. That's called it is called strips. Jyoti, okay, Jyoti, I have got the answer. Let me check it. Sir, do we index the cost of acquisition in the index one? Cost of acquisition is totally separate. So that it is totally separate because cost of acquisition is relating to the other aspect. Okay, I could not get exactly in what context you are saying because when we shall discuss the merger acquisition, there might come. But here, student, one student has got the answer. Of course, we shall check the same. Jyoti, I think you have taken. I think you have taken. Let me check. One divided. I think you have considered 10,000. Let me check. I have considered 1,000 value. You consider by the same beta. Yes, your answer is right, but only the point difference is there. Something. Okay, student. So now this value here, see, this is the value at which this bond shall be issued and it will be written at 1,000. Okay. So the difference portion, of 190.75. This basically interest for the period of holding. Okay, students. So I hope with this it has been clear. Although it is called zero coupon, but of course it is not coupon. It is paid, but it is paid cumulatively. Yes, Tanisha, your answer is correct. Uh, Jyoti, yes, not, but I think you have considered it as a 10,000. Otherwise, your answer was correct. Okay. So, student, please note. Now, I just give you a very simple example. I think in your, if you are doing when you are doing some calculation of the income tax, there is a concept of NSCs, National Savings Certificate of the Post Office. Normally, what happens? They are issued as say, sorry, my mistake. I'm again using the dollar. Say an instrument of say 10,000. I'm not exactly not is not known to me what is the rate of interest is going on, but approximately I remember that it if say I have I have taken the securities on Fund 1 2015. After I think it is tenure is 5 to 6 years. So after 5 years, the post office returned back me this much of amount. Okay, so on 31st, 15, 16, 17. Okay, now after 5 years, if post office return me back this amount, so accordingly, my 6,617 is my interest portion. Okay, I'm just saying with only just my estimation, but the amount may be less. I think somewhere it may be 15,000. I'm not exactly sure. So 5,667 is my interest for the 5 year. Now what happens as per Income Tax Act? If you recall that normally for this 5 year, 5 years, but we take accrued interest in our computation of income. In our computation of income. So because it is kind of a zero coupon bond, only the difference is that here the amount is this much if paid. Only in a case of a special zero coupon bond, normally par value is written. So accordingly, we segregate our interest portion to the 5 year. We charge the interest. So accordingly, you can say that of course we are earning, but we are earning at a cumulative. Okay, student. Now I'm coming to the next corporate we have discussed. Now next I am discussing with you the floating rate bond. Now these are bonds. These bonds are basically uh, say what is floating rate. Student, there are two type of rate of interest. One is fixed, another is floating. Okay, now if I say a company has issued 8% bonds. Okay, so this means this 8% is fixed. This 8% is fixed. It shall remain the fixed. They say 8% bonds of the 6 year duration. So for the complete 6 year, the company will pay to the holder of the bond, say the bond amount say 10,000. Okay, the bond par value is 10,000. So it amount comes 800. The company will pay 800 for the 6 year, and in the end it will pay back 10,000. Of course. Now here the question comes, this 8% is fixed. Okay. In the case of a floating, what happens? Normally, this is benchmark. Interest is linked to some benchmark rate. Okay, this benchmark rate can be your prime lending rate. Now it is no more. It can be MCLR. I think it is a marginal cost of lending rate. It is something like that, or it can be your treasury rate, or there is another term you have heard about LIBOR. As I told you, LIBOR is no more. So it can be MIBOR. Okay, it can be Estonia. It can be Ester. So these are rates to which you can attach a rate. Now what happens? Earlier, I think somewhere in around 25 years to 30 years back, SBI has issued floating rate bonds where they have issued the bonds saying that we shall pay 300 basis point. Now, student, what is this 300 basis point means? Here, I will also invite your attention. The bank said like that they will pay 300 basis points. I'm just saying basis point about the fixed deposit rate, about maximum fixed deposit rate offered by bank. Something they have said like that. So in this case, what happened? The bank has said that, okay, now if you are issuing the bond, they are issuing the bonds. They say, suppose they have issued the bonds say 1198. Okay, they say, I'm just for example saying, I'm saying, of course it was a real case, but exactly not. I have not no idea about the real amount. But I'm just on the same facts I'm saying. They say we are issuing a bond of 10,000. Okay, whatever be the fixed deposit rate offered by the bank. Now on say 31st March 98, the fixed deposit rate suppose is 6%. Okay, so they will pay you interest of 9%. Okay, so accordingly the amount will come 90. Now on say 31st 12 9,000, the fixed deposit rate, maximum fixed deposit rate is say 5%. So accordingly they will pay 800 because it comes 8. Similarly, on 31st 12 2000, 2000, the FD rate has become 5.5%. So accordingly they will pay you as. So you can see that accordingly they are paying every year. The rate of interest is not fixed. The rate of interest is not fixed, it is varying because they have attached benchmark their payment to this fixed deposit rate. Now, student, I think you must have an idea. Basis point means 1 basis point mean is equal to 0.01%. Okay, accordingly, 300 basis point means 3%. So, okay, student. So I hope you have an idea what is floating rate bonds. Okay, 1 second. I just need to check here. Suraj, it may be EBLR beta. I'm because we used to call it as a MCM, marginal cost of lending rate. I think it used to be term. Now it may be EBLR. It can be anything. You can benchmark the interest to any, and you can link to your bond to any benchmark. Now, student, I am coming to the next bond that is called junk bonds. Now, as the name implies, junk means no use. Similarly, in junk bonds, normally they are very bonds issued by any risky companies because the company may be in a say is not performing well. It may be due to any reason. Sometimes they come out with the issue, or it may be possible that suppose a company may have issued the bonds of say 10,000, say around 20 years back. It was going on well. What happens? All of a sudden, there was some financial difficulties with the companies. Okay, so it may be possible that this may even they say the bonds have been issued at say 5%. So the company is supposed to pay 500 interest per annum. Now it may be possible that due to financial difficulties, the company may have stop paying the dividend. Okay, the company may have stop paying the dividend, but not dividend, sorry, interest. Okay, so of course when they are not stop paying the interest, the debenture start losing its value. Okay, now we shall when I will talk about this is what are the various risks. Then I will also explain in detail. Similarly, it may be has become doubtful whether the company will repay their debentures on the maturity or it could be able to repay or not. So in that case, what happens? There used to be some kind of a postponement. Okay, they say ki, okay, we shall pay after 5 years. Now today say maturity, the company says I want some more time to repay my debenture. So in this case, this debenture it may be possible that may lose the value. Okay, nobody is ready to buy the same, but some investors have a risk appetite. They may say, okay, I will buy it, no problem. I will buy it at 8,000 because they expect that if the company starts performing well, we shall get back our money of 10,000 and accordingly for gain of $2,000 on 8,000, say within a period of 1 or 2 years, such a nice gain. So these are quite risky bonds. These are called risky bonds. This is Naja Shakir TK. Hello, sir. Second part of the recorded lecture of security analysis is not available. Whatever you want to say, I will check the same matter. Don't worry, I will check the same. Okay, student. So I hope we need to more discussion on the same. Now, next we are coming to index bonds. These kinds of bonds are bonds uh, which have, you can say, index. Index to means they are related to index of some uh, any benchmark. Okay, this can be your interest rate, this can be your inflation. Now, generally, these are compensated for the inflation risk. Okay, as you know that when in our earlier class there was a concept of inflation risk, inflation, or you can say when Devas sir was teaching. So nominal when he was talking about nominal rate, so real rate into nominal inflation. So inflation, what happens with the inflation? The rate of I just give with inflation the value of interest goes down. How it happens? Say now, suppose a company has issued a $10,000 bond, or I say no rupee, I use my rupee. I think it will be better if I use the term rupee. Now, a company has issued, say, bond of say 10,000. Okay. Now they have issued the bond of say 5 or 6% bond. Okay. So what happens at the time of first interest payment, the amount comes 600, then it comes 600. So this is the three payments. Now suppose if the inflation is there, say inflation is at the rate of 3%, then what will happen? This 600 value will be less, will be less. Why? Because the nominal rate of interest have become, okay student. So though the bank bond has been issued at 6%, but due to the inflation factor, this 6% bond has lost its value because interest is coming at 600, but due to inflation, it is not have the same value. Or it can we can say that if we use the PV factor discounted by, because it has lost its value, 600 divided by actual value is basically 600 divided by 1.03. It means value is 582.52. So it means the interest it is losing its sheen. Okay. So that's why what happens, index bond says whatever be the inflation, I will adjust it. Accordingly, at the end of first year, they will pay the interest at the rate of 98.18%. So similarly, if interest inflation is in second year is 9%, 2%. So they may be possible. They will say, now we shall pay you interest. Now they will pay you interest at 11.6. So they are in that way they are compensating. They are compensating. Tanisha, yes, you are right. Very good. Okay, student. So this way, this is called index bond. It means they are indexed. So bond interest is normally not the they may issue the face rate. After that, they may compensate according to the any basis or the or index they are using the for this calculation of interest. Okay, student. Now I am coming to next. Okay, convertible bonds, callable bonds, and portable bonds. Of course, convertible bonds we shall discuss in later in detail. They are converted into, they are given their equity share. The bondholder is given the option that they can get converted their debentures into the equity shares. Tanisha, you are right, beta. Actually, we have said ki how much interest will be affected. Okay, now I have shown 582 point. It is just note it down. Suppose if I am on this point, I am on this zero date. I will say that company says I will pay you the 600 interest after say 1 year. I will say, okay, you will pay me the interest at the 600 rupees, but due to inflation, its value will be remain only 582.82. That will be my opinion because of inflation. Only that I have shown to you. Okay, because due to inflation, the value is decreased. Now, when we talk about the convertible bonds, they are normally converted. Holder is given the option to get them converted at a some number of equity shares. It is at their option. Okay, now I recall that this convertible debentures has become very popular somewhere around in 1995, where I think Reliance Industries has issued some triple option convertible debentures. I think I need to just recall because I need to some more need more time to study. But I recall that in this time, what used to happen, the company has issued a debenture, and because since the company has given the option to the debenture holder to get them converted into share, what the investors and the debenture have a huge benefit because the company's share was on a very high price. So accordingly, they are getting them converted and selling the share into the market and booking a huge profit. At that time, I recall it was somewhere around 94, 95. I still remember. So at that time, many debenture holders have earned a huge amount. Now, when we talk about callable bonds, this is a kind of an option with the issuer. Okay, and it means the issuer can be call back the bonds at any time before the maturity to get them redeemed. Okay, of course, this relating to your bond refunding decision that we will discuss. That initial class we have discussed. Now I will take another one or two questions. So basically, it is relating to the issuer point of view, and this to I want to avail the option that I want my money back before the redemption, before the maturity, before the maturity. So it may be possible that it because it depends on how I want because now we can see if we talk about this callable and option. Okay, but this is a kind of a option. It is not an obligation. Please remember, it is not an obligation. It's my choice. If interest rates are falling, then company issuer will exercise this option because in a bond refunding decision, we have seen that earlier we have issued the bond at a higher price. Now what we shall do? We shall refund the bond and we shall issue the and interest rates are falling. So we shall do? We shall refund the bonds that have been issued at higher price and reissue the fresh bonds of the same amount. Okay, because we are saving the interest. Similarly, in a putable option, if interest rates are rising, as an investor, what I will do? I will get back my money back and I will I will purchase the new bonds. For example, as an investor, I have bought 6% bonds, say 5 year back. Now today, just suppose if interest rate is prevailing interest rate is 9%. So what I will say, I will refund this bond, get refund this bond, And one second. I will refund this bond. I will give this back to the company, and I will say I want my money back. And whatever is the money will become, I will reinvest it to 9%. Here the company, what is doing, they are redeeming their bonds and reissuing at a lower rate. Of course, these options are not free. Here the call premium is charged. Okay, when the company is asking, saying I want to return the money at early, so they have to pay some call premium. Here it may be possible that company may pay less amount. Okay, it may be possible that they may less amount, or it may be possible that generally what happens, they not normally pay the less amount. The interest rate is quite less compared to the market because they are banked by the option. Tanisha is asking, sir, one second. She is asking, uh, sir, could you please summarize what is the difference between index bond and junk bond once, please? See, junk bond only the company that is facing financial difficulties. These are issued, not issued by, even they may be issued freshly, or there may be bonds may be trading in the market. They will be trading at a discount. That I will discuss with you when we start doing the calculations. In case of index bonds, normally the company is doing the well. There is no problem with the company. Only company is saying, hey, I will not pay the interest at a fix. I will compensate you for some factors like inflation factors. Only this inflation factor will be changed. Say tomorrow the inflation is negative. Of course, the company will pay the negative rate of interest. The company will pay the lesser rate of interest. It may be possible that. So normally the company compensate for you some indexation. It is just like saying when you talk about the in income tax, when you take in a capital doing the capital gain computation, you do indexation. It is just kind of a same thing. And you are asking, sir, why a financial institute issue callable or putable bonds is there is no reason. Now see, callable or putable bonds is because when the company issue the putable bonds, na, normally say if today's rate of interest is 6%, the company is issuing the portable bonds, they will not issue at the 6%. They will say we shall issue at 4%. Now it is a choice with the investor because they are paying indirectly 2% for their price. Same bond, except the portable clause may be issued, may be available at 6%. But if you are going for this portable bonds, it may be possible that the company may will issue at a 4% because they will charge some premium in that form. Similarly, callable, the company may be issuing some bonds and they will say, whenever we shall call the bonds before maturity, we shall pay you some premium. Only that is the thing. Okay, students, one second. Now, students, this was a brief summary of our this basics about the bonds or debenture. Okay, just a second. I see what anything has been left out. So that okay, student. Now I am coming. This is the some I have discussed the basics about the bonds because before doing the numericals, it is always better you should understand what are the nitty-gritties of the some any financial instruments. Now, what are the topics for the discussion in our session remaining because even our syllabus also. First of all, the price of bonds. This will be our basis. We can say this is form the basis of valuation. Okay, second, okay. Now, what are the various types of a bond yield? Because if we when we talk about shares or debentures, there is a concept say I am buying a share, I will get this much of dividend, I will get this much of capital gain. What will be my return? Of course, capital gain plus my dividend divided by the price I am paying. It is called return on equity. It is called return on equity. Similarly, we can also discuss the various types of we can say yields that will be available on a bonds. Okay, this can be current yield, YTM, yield to maturity, yield to call. See, YTM means what will be the my return on a bond or a debenture if it is held till the period of maturity. It is a kind of a IRR. Okay, it is a kind of a IRR. If you recall that, I take back to your intermediate. It used to be a KD. It used to be KD, cost of debt. If you recall that. Okay, student. It used to be a cost of debt. Now, when we used to be compute a cost of debt, it used to be from the point of view of the company because there we used to deduct tax. There we used to deduct tax because interest is a tax. There we used to do 1 minus t. Here now in our valuation, we shall see we not normally use the taxation because we compute the value independently. Because a person may be in the tax bracket or may not be in the tax bracket, and if he is in the tax bracket, it will be questionable. So normally here we consider the interest without the tax. Okay, so I'm just giving a small hint. Of course, don't mix up with the KD. Now yield to call. Yield to call and YTM is the one and same thing. Only it is held till the maturity. Okay, and it is before the maturity. So procedure is the same. Okay. Here we compute it by IRR. It will also use compute by IRR. Okay. Now next is holding period return. Okay. Okay. In this annual interest plus capital gain, if any, divided by purchase price of the bond. Suppose an 8% bond is available at, okay, now this is available at rupees 100 face value is available at 97.8. Now say after 1 year, if it is hold for 1 year, so I will get interest of 8 in the 1 year, and I will get if I will get the redemption my back So my return will be, so this is my holding period return. Okay, student. Now next, the next can be discussion for our topic is rating of bonds. Now, when we talk about when we say rating of bonds, it basically means what happens. A company may have a rating. What is rating? Rating means what is the credit standing of a company. You must have heard the rating agencies like Moody's, Fitch, CRISIL. Okay, there is another company is CRISIL, Moody, Fitch, and there are one or two companies I'm not recalling their name. CRISIL, and there is ICRA. I think it's the ICRA. Maybe I maybe ICRA. There may some credit rating agencies are there. Okay. Yes, Tanisha, you are right, beta. Your answer is correct. ICRA. Now, these are rating agencies. What do they do? Whenever any company is issuing the bonds, they may have a given some credit rating. So they may be using some like symbol. Every company has their own symbol. This rating. So the rating indicates their credit worthiness. Like as a very good question, a student has asked, what is junk bond? Now here, if a company has a rating of a B, it means it's a highly risky. So they may have a B rating. On the other hand, the company with a good standing, so they maybe have a rating this much. And very important to note that students, good rating means lesser interest rate, and high rating means, or sorry, low rating, higher interest. Company need to pay. The bond issued has to be on a higher rate of interest. Okay, student. Shruti is asking, sir, callable or portable में difference बता दो. बेटा 2 minutes. I am just completing it. Then I will explain you. Now here, if my credit rating is good, everybody will wants to buy my bonds. So I need not to pay that much of interest. And what happens? I just give give you example. A company is having a not good rating, they have to offer more and more interest rate. They have to offer more and more interest rate for bearing this risk by the investor. So in this case, what happens? Generally, what happens? Some benchmark rate is used, and benchmark rates are basis points are added as per credit rating. Say if I say benchmark rate is Mibor, okay. Now they say Mibor is 6%. However, the company may be poor credit rating, highly risky. They may say, I will give give you the compensation of 5%. It means I will issue the bond at 11% because there is no guarantee. This not even 11%, be it 11%, it may be possible that you will not even back your get back your principal back. On the other hand, a company with a good credit rating, say it may possible. They may say, I will issue only. So it depends upon the. So that's we can see how the credit rating and bond value are linked. Of course, we shall when we shall do one or two questions on the same. Then you will understand the concept. Now, sir, care. Yeah, care. Very good. Care. I not agree. It's also care. You're right. Care is another rating agency. I forgot the name. Now, student, please see. Tanisha, you were asking, sir, portable or Shruti, you were asking. Portable or callable bonds means callable bonds. These bonds can be redeemed by the issuer, that is company, before its due date of maturity. Portable bonds means by it can be issued that can be lodged with the company by the investor before its due date of maturity for redemption. Okay, so in callable option lies with the company. In a portable investment lies with the investor. Yes, Mansha, you are right. Good rating means less interest. Suraj, on the what basis this rating? See, Suraj, there are many criterias because it itself is a very big topic and there are a lot of studies are involved. Of course, maybe once you become a chartered accountant and maybe some of you maybe got employed by these companies also because there are many factors we have to study and very important. These factors keep on changing. A company does not hold the same credit rating, say on a continue to hold the same rating. It keeps on changing. It because it depends a lot of factors, and that's why it has sometimes it has come because for credit rating, the credit rating can be obtained by any financial institution or the lender, or it can be credit rating can also be done by the credit rating agencies at their own CEO motto because these are there are many nitty-gritties in this. Yes, Jyoti, you are correct. Almost like as a floating rate, but difference is basing point. Yes, you are right. Basis point are this as per credit rating. You are right, beta. You are right. Understand? Or the rate of return and so on. No, rate of return. Tanisha, you are talking about the credit rating is normally on the other factors, not rate of return. Not rate of return, it is on the other factor. Generally, companies, financial solvency, promoters, lot of other factors are there. Use. Okay, madam. Now, so I hope reading you have understood. Now, another term I'm discussing with you, topic for discussion will be term structure. Now, when we talk about the term structure, student, please note here. Uh, I just take back to you when we are talking about the valuation because it is start now. Our we are coming near to the valuation topic just now. Now, what happens? Valuation of bond is basically related to the time value of money. Okay, and here it is based on the discounting factor. And for discounting factor, we need some rate, and this rate is provided by this term structure. Now, what happens when we talk about the bond valuation? We say, whenever we shall see the question, we shall say the investor expect this much of return. Suppose when we were talking about this topic of equity valuation, in equity valuation, the concept was the KE. Okay, the KE can also be calculated by using the CAPM model, capital asset pricing model. Normally, this is based on the risk or systematic risk of a company. Okay, now this will be more detailed discussed in the topic of portfolio. I am not going into the CAPM right now. Now, CAPM provides the minimum required rate of return that can be expected by an investor by investing in the share of any company. So, by using this KE, we are using the computing the value of equity. Okay. Similarly, or you can say it is expectation by the investor. Now, in a similar manner, how much if investor expect, that depends on the term structure rate. Now, this term structure rate provides the basis for the valuation of bonds. This structure can be of a four type that we will discuss later on in a detail. Okay, but for the time being, I'm just sharing with you. It is only the basis that provides the rate for discounting the debentures or bonds. Okay, now next topic that we will discuss, bond duration. Now it is a very interesting topic. The reason is that when we talk about the equity, we say equity is a volatile. We say no, but debenture or bonds are not volatile because we will get the fixed rate of interest. If I am talking about a simple plain vanilla bond, I will say my there is no volatility in my bond. No, it is not true. There is a volatility in the bond also because the value of bond also dependent on the rate of interest and how much what will be the volatility that we should discuss with the concept of bond duration. So we shall discuss this topic in very detail. Right now, for your just for this hint, I'm just covering here. That is what topic shall discuss. Then after that, we shall come to the analysis of convertible debenture. Okay. Then we shall cover refunding of existing bonds and issue of new bonds. Okay, although I have just touched upon one question in my first session here, one or two questions are quite involved some transition period of interest. Then last, we shall come up with the money market instruments. Okay, student. Quickly before we go to the break, I just quickly coming up some what are the various risks involved in the attached with the bonds. Uh, Tanisha is saying, one second, just let me take the query. Almost like a floating rate, but at VP as per credit rating. Yes, Jyoti, you are right. And sir, rating does done based on riskiness of the rate of return. Okay, I have taken the query. Okay, no problem. Now, risky. Now, what are the various risks attached to the bonds? First of all, interest rate risk. With the increase in interest rate, the value of bond goes down. With the falling in interest rate, the bond value goes up. Now that will we see. There are many questions on the same. Then it comes to inflation risk. As I explained earlier, with the inflation, the value is going down. Default risk, it can be in the interest payment or principal or both. These are the various risks. You should have an idea about what are these kind of risks. Of course, okay, then it comes a liquidity risk. The company does not have the money to refund the amount or interest payment. Then sovereign risk. Here, sovereign risk means the government defaults on the payment of bonds. Okay, the government defaults on the payment of bond. It happened somewhere around in 2008, where the Greece government has defaulted on its payment of the bonds that has been issued by them. It was somewhere around in 2008. So this was called the sovereign default. It was called sovereign debt crisis. Reinvestment rate. It is an important risk because that will be used in when I will discuss the topic of bond duration. There, then I will discuss this top interest rate. Reinvestment risk means, suppose I have purchased a bond of 8% of rupees 10,000. Of course, it means at the end of each year, I will get 800 rupees as my interest. Now, what happens if in a market 8% of interest is prevailing? Then I have a no problem. I will reinvest this 800 rupees at 8%. No problem. Okay, if rate of interest is 9%, I have a no problem. The problem will start when this interest rate say is coming 6%. Now what I am losing? My reinvestment rate. So this falling of interest rate, or it can be saying that risk is two-way. It can be up or down. So if in market, if reinvestment rate is not same, then I'm affected by this risk. Okay. Of course, then we cannot say it is a problem, but change in the reinvestment rate is called reinvestment risk. Okay, student, let me check. Tanisha, it is mandatory for a company issuing the debt. There's a mandatory for issuing the debt to get their company bonds rated. It is not in case of equity share, but it is mandatory in the bonds or fixed income securities. US bank crisis 2000 last best example of interest rate. I think you, Mansha, I think it may be bank crisis, interest rate. Not we cannot say that default because I am not exactly idea about this, but to my knowledge, I think it's some kind of a ALM risk also, maybe linked to that. I remember that little bit. So I cannot comment on the same because I'm not that much of knowledge on this aspect. Okay, student. With this, we are taking a short break. After the break, we shall start discussing the assignment with you. Okay, student. Let's have a break. Small break. Ashok ji, break. Begin. Okay, students, welcome back. I just before I proceed further, let me check I have whether I have any query. Okay, student. Now let us start solving the assignment. Now the question number one. The question says like that the nominal value of 10%. It means 10% interest will be paid of bond issued by student. In my assignment it may be right, but here it is a SK Limited is rupee. A bond is 100 rupee per value. The bond is redeemable at rupees 110 at the end of year 8. Determine the value of bond if the required yields are this. So here these are the required yield. 4 yields have been provided to us. So we can say it is kind of a white yield. Of course, PV factor table has been given to you. Okay, next is asked when will the value will be the highest. Okay, student. Now let us start solving the question, and with this one we can say one aspect of the bond valuation will also be covered here in this question. Student, first of all, we start value of the bond. Here, okay, student. Now here we write the period. Then, student, we shall see when, as I told you in the beginning, when we talk about the bond valuation, it is basically relating to time value of money. And similar as we normally do in capital budgeting decision, where we use the present value factor. Here we shall follow the same method because capital budgeting is based on the time value of money. Again, like in our capital budgeting decision, we cash flows. Okay, student. Now, what is does it mean by how much value is justified? How much value is justified of a bond that is paying 10% of coupon? Okay, and redeeming at a par. Okay, redeeming at a, sorry, it is redeeming the debenture because please see here it is saying it will be redeemed at premium. So they are redeeming the debentures at par. So you have to see how much price is justified. If the present yield is expected yield is 8%. Okay, student. Now present value factor has been given to you on the table. Okay, accordingly, if I sum up all these factor 1, 2, 3, 4, 5, the value comes 3.93993. So accordingly, I use here the factor because it is my coupon payment. So I multiply with this. The present value of interest portion that will I receive from this bond holding this 50 year It is principal plus premium. Okay. Now here the present value factor is 0.88, 0.681. Accordingly, value comes. Okay, student. I hope very simple. You can understand how we have simply computed the. So this much of price is justified for a bond as on date, for a bond that is paying 10% coupon. It is. Okay, now next we compute quickly. Okay, now when required yield is our 9%. Here, cash flow. Because our total of these factors, this comes 3.889, and last factor is 6, 0 point this. Okay. In a fifth year, principal plus premium, sorry, 110. Okay, so this much of value is justified. Okay, now let us move to next one. When yield is required, yield is 10%. I'm just writing down the line here. One to 5 year again. Okay, student. So here our value of PV factor, the total comes at 10%. It becomes 3.790. And last factor is 6, 0.621. Okay. Quickly, let me do it so that we can. Okay, student. So this is a justified price. Very good. Students are computing at their own. Mansha, you are correct, beta. Jyoti, you are also correct, beta. There is any minor difference, don't worry about the same. Don't worry about the same. If there is a rounding of some small difference, there is no problem. Now last is our required yield is 11%. Accordingly, 1 to 5 year total, the value of total comes 3.696. Okay, student, the last terminal value we can say. Okay, student, so we have reached to the four values, this. Okay, this value. Okay, now what I do summarize these values. Say if the required yield is 8%, the value is 114.84. If the value required yield is 9%, the value is 110.39. If the required yield is 10%, the value is 106.21. If it is 11%, the value comes 102.19. Now, student, now let us see. If we see these values, we can came to know there is a price yield relationship, bond price yield relationship. There is a relationship. Now, this relationship will be understood from this analysis question. Now, let us see. Let me show you. Now, if I start drawing, say here, if I take yield and here I take the price of bond, so we can draw here, say it is 8%, it is 9%, here we can say 10%, and here it is 11%. So I start seeing that the value is going down. Same way, if I plot them on a graph, the value comes like this. And if I join this line, this is called inverse relationship. Yes, Mansa, you are right. Okay. So this is called inverse relationship. Sorry, my mistake. Okay, student. So this is a kind of a relationship that is shown. So we can see with the increase in yield that there is a fall in the value of bond. Okay, student. I hope with this the price yield relationship must be clear to you. Now we are coming to the next question. Please read out the question quickly so that we start solving the same. Now here it says an investor is considering purchase of the following bonds. Face value is rupees 100. Corporate coupon rate is 11% and maturity is 3 years. If he wants a yield of 13%, what is the maximum price he should be ready to pay? Okay, simple procedure. So we compute simple rupee because coupon is 11. So our per month interest will be 11 rupees into PV IAF. If you recall that, or PV annuity factor, present value annuity factor. Since my yield is 13%, so I will use the factor of 13% for the 3 year plus rupees 100, that is maturity. Student, please note if nothing has been mentioned in the question, then it is always presumed that it will be redeemed at par. Present value factor, not annuity. Here it is present value factor at 3. Student, please continue to make your calculation and calculation also. I am wrong at any place, please get me corrected. Very good, Jyoti, you are right, beta. Jyoti, you are right. Because if you start doing the calculation, it shows that our classes are not only monotonous, it is a two-way communication. And that the class is more effective when it is a two-way communication. Now next it says, if the bond is standing at 97.60, then what would be yield? So it means we have to call YTN, and as I told you, we shall use the procedure of IRR. Okay, we shall use the procedure of IRR. Now, student, sometimes it comes into the mind when we have to calculate the IRR. So you know that I will not reiterate what it is IRR, as you are well aware that now for IRR we need normally two rates, two discounting rates. So the question comes into our mind, which two discounting rates we have to use. Student, for this there is a golden rule. If in the examination some rates have been given to you, then you can judge. Okay, then you can judge, because it may be possible that you may be given two or three rates. From there you can came to know that suppose in the given question our coupon rate is somewhere around 11%. Okay, so of course our percentage will be lying between 10 to 12%, somewhere 10 to 13, not lesser, not too much higher. So somewhere we need these two discounting factors. If in the question 11 or 13% has been given to you, then it's okay. If 10 to 12 has been given to you, you can use the same. So by this, you can use the same whatever. In case if it has nothing given to you, then you can assume at your own. But my request to you, please don't take too much far values. Okay. So now my since rate of interest is say 12% only. Okay. So 11% only. So I what I do, I do discounting on two rates. Okay. One rate is at 11%, another is at 12%. Okay. Now let us discount at 12%. Now today I am investing a money of 97 rupees 60 paise. Okay. In lieu of that, I will get interest, and in the end, along with the interest, my principal will be refunded. True. Now what I do, I use PV factor at the rate of 11%. Manisha, let me check beta. Yes, your answer is 90. Let me check. Hmm. Yes, Manisha, your answer correct. But here we have to compute. Shruti saying, sir, why at 12%? No, student. Sorry, my mistake. Initially, I am doing it at 12%. Here, I have to mention 12%. Sorry. Or I can start with the 11%. It hardly matters. One second. Though I have mentioned 11%, but I'm just doing it at 12%, then we will see. You can take 13, no problem. You can take 14, no problem. Okay. Jyoti, Masha, Tanisha, you are all right, but see here we have to compute PV value. Now basically we have to compute net value, NPV kind of a thing. So that let us see. We're reaching there to the answer, don't worry. Now my present value factor at 1% here is 1. If my calculation is incorrect, please correct me. Yes, Jyoti, you are near to about, I think it's 97, but let us see here. Of course, you have done 97.60. Basically, it is a price. Okay. Yeah, it's my mistake. Student, sorry. I have considered it up to the 5 year. Manisha, you are correct, beta. I have to here consider 3 years. Sorry. Just student, my mistake here. We have to take now. Fortunately, our value is only 0.02. So please see, student. So we can say that YTM is equal to 12% because this is very minor difference. Manisha, you are very correct, beta. It is a right. We should take the CS value. Okay, student. So the YTM will be 3 year. While YTM will be 12%. Okay, student. Got this? Okay, student. There is one alternative formula. There is one approximation formula that you have discussed in your cost of capital. I'm just reproducing here again. So the it will also give the same values nearby. It is an approximation formula. Please note, it is not a accurate formula. It is an approximate formula. In the question paper, it is say it is only for 1 or 2 marks, 2 or 3 marks question. You can use approximation formula, but if it is the mark weightage is around 5 or more or 4 to 5, I say 5 or more, then use the interpolation method. Then yes, it is now it is 12 because value is very nearby. Okay, student. Okay, student. Now I am coming to question number 3. It says like that John inherited the following securities on his uncle's death. There are 10 bonds, face value 1000, annual coupon 9%, maturity is this, and yield is this. So it is a YTM, required yield. So it will be considered as required yield. Coupon rate is 9%. The interest will be paid at 9%, but similar type of a bond is yielding a return of 12%. Similarly, 10 numbers of bonds are there. Here the rate of interest is 10%, the maturity period is 5, and here it is the value is 12%. Okay. Now next is preference share of rupees 100, 11%, and here it is written as it is likely to be called over the premium. But we shall not consider the premium because we don't know what will be, because preference shares are normally never redeemed. Generally, if there can be redeemed, but right now there is not any chance of redemption, so we are not considering the yield. Here the yield is 10%. Preference share this and this. Okay, student. Now here all these are fixed income securities. This is also fixed income securities. Now this is a fixed income security. So now we shall see the valuation. Now here the yield is at our yield is 2.402. Accordingly, the value comes. PBIF and here 12% for 3 year. Okay, student. Then bond B. Okay, the factor is 3.605. Now we come to the valuation of preference shares. Now students, please see here, since the period of Shruti, beta, yes, you are right. Shruti, your answer is correct, beta. Now see here, student. Now since the period has not been mentioned, so they will be considered as irredeemable. Okay. Now when we consider as irredeemable, or we can say it is a perpetual preference share. If you recall that there was a formula KP. Okay, where what you used to do DP upon में issue price, DP upon में D1 upon में issue price. Okay, student. So dividend was a fixed. So D0 we used to say like that. Now here, see if we see the question, it is basically the required return from the preference share. That is, we can say it is a KP. Both are KP, cost of preference shares. Accordingly, dividend is known to us because here the dividend is 11, here is it 12%. For 100 share, it will become, okay. So preference share C, KP is equal to 13. Okay, dividend is our 11%. Price we want to compute, what is the justified price? Okay, we want to know what is the justified price. Accordingly, the price of one share comes out 11. This it becomes, okay, since there are 100 shares, it becomes 84.62 into 100. Okay, similarly, we can compute the value of preference shares T. Same manner, KP dy upon P, P is equal to D. Here the dividend is 12 and our KP is this. The value comes per share. Okay, since our number of preference shares is, uh, one second, sir, why, Tanisha, sir, why we have given coupon rate and yield rate together as two different rates? Sir, why we have given coupon rates and yields as a together? See, beta, what happens? Yield is normally dependent on the various factors because when the coupons or when the securities are issued, then circumstances may be different. Today, the yield may be different. So that's the difference only. That's why they are not really found same. Since our value of preference shares be 92.31 into 100. Okay, student. So the overall value, we can see our overall value of the wealth comes here. It is 92 point this. We can total value becomes 36,250. Tanisha, your answer is correct, beta. Jyoti Keran, yes, your answer is correct. Jyoti, very good. Shruti 79275. Yes, Tanisha, you are correct, beta. Almost all students has done it correctly. 9230, Tanisha. Yes. Okay, student. And one more student, nine. Shruti, I think 9275. Let me check because there may be. Yeah, you are correct. For bold B, you are correct. Very good. Okay, student. So with this, we have. This is the answer of the question. Now we are coming to the uh, quickly to coming to the question number 4. Student, please read the question carefully. Now in this question it says Sonic issued 8% 5-year bonds of rupees 1000 each having a maturity of 3 years. The present rate of interest is, let me use my screen. One second. One second, students. Sonic Limited issued 8% 5-year bond of 1000 each having a maturity of 3 years. The present rate of interest is 12% for 1 year tenure. It is expected that the forward rate of interest for the 1 year is going to fall by 75% points, further 50 points, and next year this. Now, student here, okay, just let me complete the question then. This bond has a beta value of 1.04 and is more popular in the market due to less credit risk. So for this aspect, I will come later on. Now, for this, I need to draw I draw your attention to this point forward rate. Now, student, what happens whenever bonds are issued? Basically, this is a yield curve. Okay, when I was just let me do it. When I was discussing with Spectre, just I'm going taking back to you the slides. This is the term sector rate. Okay, what happens whenever we have to value any bond? So normally, as you may have seen in the till questions, we have assumed our yield shall remain the same. But in this question, our yield is changing with the period. First year it is different, second year it is different, third year difference. Basically, yields are determined by the term structure rate of interest that we have discussed, and we shall discuss in the next class in the detail, more detail. But this is used as a discounting factor that I have told you. Okay, student. Now I hope it must be clear to you. Okay, student. So now let us solve the question. So here we shall use the different rate of interest for the different years. And so first of all, we need to calculate intrinsic value and expected price of the bond. First of all, we compute intrinsic value based on discounting. Okay, student. Now forward rate of interest, what forward rate of interest or what forward yield we shall consider? Let us see. Okay, student. Now let us see the PV of interest. Now please note, first for the first year, our C coupon rate is 8%. Value is 1000. So our coupon payment will be 80. Now since our first year discounting rate is 12%, we shall use the same. In the second year, please here I need your attention. First year will come as it is. Okay, because first year has been passed. In the second year, we shall take like this. Okay, in the third year, now for the 2 years, this the rate of interest shall remain the discounting the same. Okay, student. So the value will come. Okay, student. Now PV of bond, PV of principal. Okay, student. Can you hear you any doubt? Please let me know. क्यों लिया है 8% 12 लिया है बेटा लेट्स सी श्रुति आई टेल यू बेटा देखिए लेट अस सी हियर द फर्स्ट ईयर डिस्काउंटिंग रेट इज 12% for 11 next year 11.25 so first year it will now student here I am just pinpointing because when I will discuss the term structure there are two terms. One is yield, another is forward rate. Now, please, I need your attention because that's why I have taken up this question. Very good point, Shruti asked. In the second year, I am taking 11.25 and in third year, this. Now, suppose in the question, instead of this forward rate, it has mentioned that yield rate. It has mentioned that yield rate for 1 year tenure is fall by 75%. If it has mentioned 11 this way, then what will be our answer? Then we shall discounting in. Then this will be discounted at 80 divided by 1.125 raised to power 2. Okay, this factor will be divided by, one second, this. Okay, student. But if it has been mentioned in the yield, so basically there is always note that forward rate and yield rate both are quite different. Forward rate means, I just tell you, actually here the concept of term structure comes into the picture. If I am saying that like that, first year rate of interest means 0, 1. Okay, it means 1 to 1. It means if today I am investing for 1 year, my return will be 12%. Here, if I on the end of first year, if I am investing for 1 year, my return will be 11.25. If at the end of second year, I am investing, my return will be this. So this is called forward rates. Okay. Had I mentioned it as a yield rate, then the answer would be like that. Please note this is a very important point in this question. And this will give the reply to your major queries. Normally, I receive the queries in this type of question. Okay, students. So here the concept of term structure comes into the picture. So our intrinsic value will be this much. Now, my expected price equal to intrinsic value into beta value. To that beta value, since this question is from our earlier examination, quite attaching the beta value to the bond is not, you can say it is a realistic type of a situation, because in a bond, normally we use the duration as a volatility. We don't use any beta like there. Okay. The PV of interest in second year again 12, and third year it is 12% again. Shruti beta, see here. Uh, uh, Here you see, Shruti, better see here, forward rate has been given from year to year basis. Yield is normally cumulative. Okay, please try to understand what our situation I discussed with you. Here, what I'm saying to you is a forward rate. Forward rate means if at the in the beginning of first year I'm investing, I will get 12%. If in the beginning of second year or maybe the end of first year I'm investing, I will get 11.25. And if at the end of third year I'm investing for 1 year, here these rates are for the 1 year. Okay, that's why we have taken like that. Oh, Shruti, you can do one thing. Still, if it is not clear, please contact me over the telephone. Then I will make you more understanding. Okay, so here I simply use this value. Okay, student, I hope the answer must be clear to you. Now coming to the question number 5. Okay, now here it says Bright Computers Limited is planning to issue demand series with a face value of rupees 1000 for a term of 10 years with the following coupon rates. Okay, students, so here the different coupon rates are have been applied to for different, for the first year the coupon will be this 8%, then 9%, and then 13%. The current rate of similar debenture market rate is it is basically YTM. The company proposes to price the issue such a way that the yield of 10 16% is compounded revised is received by the investor. Now, although the YTM is 16%, but company wants it should yield a return of 16%. The redeemable price of the derivative will be at a premium of 10% premium. So it means it will be redeemed at 1100. What should be the issue price of the debenture? So student, quickly I am just solving the question, and or if you can do one thing, you can try at your house. I am just giving it to you because present value factor has already been given to you. Okay, student. Now I am leaving it to you. I am writing here the final answer. Please try at your own. Okay, students. So please note it down. This much of answer only. You can note down the final answer here. Okay, it will your answer may be slightly different, quite point variation. So please don't worry about the same. Okay, student. Now we are moving to the next question. The question says like that: on 1st January 2003, the financial manager of Gazettes Corporation Pension Fund Trust is reviewing the strategy regarding the funds. Over 60% of funds are invested in a fixed rate long-term bonds. Interest is expected to be quite volatile for the next few years. Among the other pension funds, the current investments are into AAA rated bonds. First is zero coupon bond, 12% yield bonds, that is payable at maturity is June 2018. The interest is payable semi-annually. Semi-annually means 6 months. Okay. The current annual redemption yield, the yield to maturity on a both bonds is 6%. The semi-annual coupon may be assumed as a 3% yield. So accordingly, we have halved the same. Both bonds have a fair par value of a redemption value of dollar 100 required. Estimate the market price of each of the bond if interest rate yields are increased by 1%, decreased by 1%. Okay, the PV factors have been given to us. Okay, students. One more PV factor I'm also getting divided here. But students, please make addition of two more PV factors. Tanisha, is what is CFC? Please tell. Let me check better. CFC means no, but it is not a CFC. It is basically cash flow. Like it is rupees. Okay, student. Now let us start. I'm start solving the question. First of all, we find out the current values. Okay, zero coupon bond. Okay, student. Please note. As I told you, in a zero coupon bond, there is no coupon payment. So ultimately, they are issued at a discount and they are redeemed at a par values. Par values. Okay. So we shall compute that simply we shall use coupon value will be equal to, sorry, my mistake. It's a dollar. Okay, student. Now second is I compute coupon bond, that is yield bond. Now here the bonds is 12%. So its semi-annual will be interest will be 6. Okay, student? And the PV factor is written by this 60. Accordingly, we write interest is found 117.60. Okay, student? Similarly, I value this is yield was my at 6%. Okay. See student here, we have used this factor. Basically, these factors are at 3% because we are using the semi-annual. So we shall use the factors. Please note here, very important to note. PV factors we are using 3%. Similarly, when our rate of interest, our yield is increased by 1%, so the yield will become 7%. For semi-annual, it will become 3.5. So I do it on the next page. Zero coupon bond. But sir, interest payment on gilt bond is semi-annually, right? Yes, better. That's why I am saying, see here, in the question, bond, it is 12%. So semi-annually it will become 6%. That's why we have taken 6. Okay, madam. So we have got this payment. So similarly, we can compute the payment when there is a value of bonds when there is decrease by 1%. Now, student, I am just writing down the values here. You can do at your own because it will please try at your own. JCB, the value will be and coupon bond is okay, student. Now we see the evaluation. Okay. Now, sorry. Here now the value is okay. So we can see here the value has been decreased, here the value has been increased. In absolute term, the value has been, let us see what has been increased. 5.48. Okay, there is a decrease in 5.48. Here the increase in value is by 6.37. Okay, in percentage form, we can compute here the percentage. How we have computed the percentage? 41.73 minus 36.25 divided by 41.73. Okay, this percentage comes 13.1%. Okay, similarly, this percentage will come 15.26%. True. Now we come to the second. In absolute term, the change is 12.82, and in percentage form, I think it will be somewhere around 158.80 minus 145.98 divided by 1.58 equal to 8.07. Okay, similarly, it will be the change or 9.10%. Okay, student, let me check. You are right, student. Mansha, maybe I'm wrong. Present PV of the yield bonds will be 7, not 6%. PV, let me check better. Let me check if you have said like that PV of, yes, you are right. Please make it correction 6%. It will be 6. Yes, Masa, you are correct. It shall be 6%. Very good, true. Maisha, you are right. Okay, beta. So with this, I think today's time has been over. So we shall continue to solve. I think one or two questions has been left. Major one, two, or three questions has been left. So in the next class, we shall complete first part. We shall quickly complete this assignment. Okay, student. Then we shall come to the next solve the next assignment, and we shall discuss the related concepts. So till then, uh, you can discuss. You can revise what we have discussed today. Now here, I will just draw your attention on a concluding remark. 1 second. This table is in your study material also, where 1 second, where you can see observe that if our YTM is equal to coupon rate, then the bond will be traded at par. Okay. If YTM is greater than coupon rate, the bond will be traded at discount. We have seen from the previous question when YTM is exceeding coupon rate, the value will be less. And where YTM is less than our coupon rate, it will be traded at premium. So with this, we come to the end of the session. Student, as a customary, as a practice, I'm just writing down here my contact number where you can ask the query. And I think one student has asked query. Some if you have any doubt, you can contact me at this number 3045956. Okay, student. So you can contact me over this number, or you can send your queries through the mobile web. And first and the last, again, I thank you for patience listening. And please, I request you, please go through the concept, and we shall meet in the next class. Before I wind up the session, I check any queries there. Tanisha said, but there is an increase, then it should be 7%. No, beta. Tanisha, it should not be 7%. You are right, it is a 7% because it is a yield. But however, when we are discounting it, we shall use the half of the same. It shall be 3.5. Tanisha, I think you have any queries? Please, I think you have one or two queries. You contact me over the telephone, or you send. Then it will be. I will make you more understandable. Okay. Otherwise, I think it must be clear to you because you see here when interest rate is yield is rising from 6 to 7, so we shall take half of the same. Okay, students. Thanks a lot, and have a nice day.